Hello everyone, my name is Kamal Manocha. I represent PM IST World. A warm welcome to all of you. Today we have a very interesting webinar. You must be thinking that we have been doing so many webinars. What is the difference that we're going to bring today? And you will see as the course of webinar progresses, we'll try to bring in a difference. Markets are at all-time highs, and all of us human beings are crowded with similar emotions, which are around fear and greed. When markets correct by 1%, the way they have corrected today, or the way they corrected yesterday, we keep getting calls from clients and investors. Suddenly, fear turns into greed, and greed turns into fear. There are some managers who try to capture both these emotions and bring a balance. And Sunil Singhania, who is one of our guests today, along with Aman Chowhan, are one of those rare fund managers. Before I introduce Sunil and Aman, I would just like to tell you that today Abakkus investment asset managers, who had launched one of their alternative investment funds, specifically in the small and mid-cap space, have touched 2x as an NAV, so doubled the wealth for investors in less than 2 years. And many congratulations to you, Sunil and Aman, for such commendable work. I remember having read the report on bubble inequality, which was written in 2019, and it was well spread, and we'll discuss around that during the course of this discussion. Though both these gentlemen do not need any introduction, but as a custom, I will still spend a minute to introduce Sunil and Aman. Sunil brings with him 25 years of experience. He is a chartered financial analyst, has earlier been working for a long period of time with Reliance Asset Management Company, and he founded Abakkus Asset Manager 3 years ago. Aman, who was part of Reliance Asset Management Company and Sunil's team at Reliance Asset Management, brings with him 17 years of experience, and he is also part of Abakkus Asset Management since the founding of this company, and he brings with him 17 years of experience. Both of them come from commerce background, an MBA background. So now coming back to the main part of this discussion, Sunil, from here onwards, I would like to start the questions and answers with you. The very first question that I would like to ask you is, though you have doubled the return over last 2 years, right? How does it feel? Were you expecting it to be so sharp and so much as a return? And what is the guidance that you want to give to your clients? Because I see, there have been many investors who have been asking us about Abakkus, and the flow of funds towards you definitely has increased, because when returns come, investors see that there is a recency bias, they come and invest. Obviously, it is good that performance has been coming, and we expect it to continue. But still, both for your small and mid-cap focused and multi-cap funds, what is the guidance that you would like to give?
Thanks a lot, Kamal, for having me and Aman and Team Abakkus on your show. Thanks everyone for joining in on this Friday evening. Wish you good health in the present and in the future. Kamal, actually, if you see, we launched our first AIF in 2018, which was an all-cap AIF with a mid-cap bias, and the second AIF in 2019, which was a mid and small-cap AIF. After the initial, spurt in mid caps and small caps, which we saw till 2017, since 2017 to as, recently as mid 2020, this segment was out of favor. But we decided to go ahead and launch these products because we felt that they were offering a lot of value to the investors. So I think the point we're trying to make is that it was a difficult sell, but we believe that that segment had value, and that is the reason we sort of launched it. Obviously, in hindsight, it looks good and the returns have been fabulous. And in fact, no one expected these kind of returns, particularly after what hit us towards the start of 2020 and the mid 2020 in the form of pandemic. However, I think what has happened obviously is that earnings growth has surprised on the upside, and specifically on the mid and small cap. Both on the earnings growth as well as the interest in the markets, I think both have been a point of surprise. You mentioned a report on bubble inequality in 2019, and I would say that quality is one of our also key aspect before we invest in a company. But when we are investing in a company, we become partners in the company, and we would like to pay a price today, which would be repaid back to us in the form of future profit growth as far as the company is concerned. So our call is that, howsoever good a quality is, if the company is growing at 10%, you cannot give it a 70-80 P multiple. At the same time, if a company is growing at 25-30%, you're not going to get it at 10 P. So, value and growth have to go hand in hand. And that is the, philosophy we follow. And we can speak about it in detail if you wish to later on. In terms of what is happening now, I think, again, there is general perception that the markets have risen 100% from the bottom. They're right. The Sensex fell to 26,000. The Nifty fell to even below 8,000 towards the peak of the pandemic issue in April, May of 2020. And now it is almost double of that. However, if you just go back a little, from January 20 to today, which is almost, 17, 18 months, the markets are up 25%. So it's not that, they have crazily gone up. Obviously, from the bottom, everything looked good. Also, at the same time, we started the financial year 21 with an expectation that the earnings will degrow by almost 30-35%. But as we end the year, financial year 21, the earnings have grown a massive 20% on an average. And this is the best earnings performance in 5 years. So it is very ironical that in the year which was supposed to be the most difficult in terms of earnings, and everyone had written it off, we are having an earnings growth which is highest in 5 years. And I think that is getting reflected in the markets. The other thing is the market P is at around 19 times FY23. It is not cheap, but it is not exorbitantly expensive. And in fact, if you remove the 2, 3, 4 stocks which are very expensive from the Nifty equation, then the P falls to around 16.5 times, which is the 10-year long-term average. So our view is that even now there is obviously great returns to be made, and earnings growth seems to be also good. Expecting 100% return year after year, I would say, is not going to be possible, and it would be a fallacy. When we do our expectations as far as future return expectation is concerned, we measure it based on the profit expectations from the underlying companies which you have in the portfolio. So again, if you go back, you see the portfolio of our, both the funds, and you see the earnings growth, they've been phenomenal. And going forward from a 3-4 years perspective, our view is that our portfolio earnings should grow between 15 to 18%. And that is the base case return which we are expecting going forward.
So, you have covered most answers, and I think, whatever questions I had in my mind, you have already answered that. So I would now leave aside the question that I had thought, but I would like to, drive this from investors' perspective in a very real manner. And, the first question that comes to my mind is that, when it comes to investing and deciding which company or which product to invest with, investors try and create a story in their mind, and they try and relate a particular company to a particular personality. Like, for example, I'll tell you, Motilal is related to QGLP, which is, what they stand for. Similarly, Marcellus is kind of equated to quality and integrity, right? So how would you equate Abakkus? So if you have to think of, I would say Abakkus is value plus wealth creation, right? But how do you define Abakkus?
So I will answer the first question, part of the question, and then I'll request Aman also to take you through what we do. So one is, see what is, as I mentioned, what is equity investing? Equity investing is becoming a partner in the business. And you would like to become a partner in the business where you have confidence from a long period of time, where you believe that it makes sense financially to become a partner, where you believe that the profit which you're going to get from this partnership going forward is going to be much more than what you paid today. This is generally the 3 characteristics which you will have. So, as I mentioned to you earlier, quality is a big component of what we do. At the same time, the value which we pay today should be justified by what we are going to get in return as far as the future is concerned. We are not averse to investing in any sector, but we follow proper risk measurement, and we ensure that we have a diversified portfolio which can grow in terms of underlying profit from a 3-4 year perspective. And I think that is the way we would like to generate returns. The other thing which we have is that what does Abakkus stand for? Abakkus is an alpha generator. We don't allocate money, we invest money. Even in the large cap, it is not that we will say, okay, buy 10% this, buy 10% that, buy 10% that. For every stock which we invest in, there has to be a justification of how we will make returns which will be higher than the market. The other thing is we believe in in-house research. We have a very large team, total of 125 years of experience, because we believe that India is a country of entrepreneurs. India has a large number of listed companies, and therefore it makes sense for you to in-house do a lot of research. And that is where our effort goes. We don't mind to be the first or the only investor. If we have done our work properly and if we have full confidence, then we don't wait for others to come in. We don't mind to be the first and only investor. And then we have a full process. I would request Aman to take you through our needs framework, which will basically give you a full perspective of what we do. So Aman, you can just briefly explain what does needs stand for and how we select stocks based on that.
Sure. Thanks, Sunil. So MEETS is a framework that we follow across all of our strategies. And what does MEETS stands for? It's M for management, E for events, E for earnings, T for timing, and S for structural stories. I'll just briefly take you through each of them. The first is obviously management. This is the single most important factor that we look at any company, because ultimately it is the management's vision, the management's hunger, the management's capability, which will ultimately determine how well a company does. And it is company's performance which will ultimately get reflected into the stock price. So for us, management is the most important factor here. Soft issues like corporate governance, minority shareholders treatment in the past, to succession planning, shareholding, all the other aspects gets included in this point. The second is another important point, which is earnings. As Sunil was mentioning, we focus on earnings. We all like value investing. We all like cheap stock. The fact is that if there is no earnings growth, value remains value, or sometimes even becomes deep value. So value has to come along with the trigger. It has to come along with some earnings growth, and that is very important for us. So for us, earnings growth is a must. If we find that any company in the portfolio earnings is at risk, or we are not confident of the pace of earnings growth for this company, we would like to avoid those names. So just not the numbers, but even the sustenance and the quality of earnings. If you're earning without any cash flows, if you're earning just on paper, if you're earning just on P&L, which is not getting reflected on the balance sheet, then clearly these are the red flags, these are the checks the investment team follows here. And hence, we do a thorough check on not just the reported number, but even the quality of the earnings. The third thing is events. By events, I would say that every company goes through a cycle, every sector goes through a cycle, and there are certain events which happen during this course. It could be M&A, it could be splits, it could be government-related events which could impact the business of the company. So we very closely follow these events, because we feel most of these events could be a turning point. It could be positive, it could be negative, but it could be a turning point. If it's a turning point, then it necessitates some action. If you own something and something goes wrong, then you have to take a corrective action. If you don't own something, there is a macro change, there is a sectoral change, there is a change of view, there is certain events, then that necessitates that to look at that sector or the company for a potential investment candidate. So for us, we very closely monitor events both for the portfolio companies as well as the market at large. The fourth thing is timing. Now, it's a classic statement, and we all follow that we can't time the markets. By timing, I mean that how we would like to time our investment. We don't time the market, but we can definitely time the investment that we enter into, especially for cyclical stocks. We all know that cyclical companies have a 2 to 4 year horizon, when there is a certain period when they do exceedingly well, and then there is a downturn. For example, steel. This sector was in doldrums few years back. Last 1 year, we are seeing excellent price move for steel companies. Loss-making companies are now turning profitable. If the current trend continues in next 1 2 years, many steel companies will become debt-free. So obviously, we would like to time our investments closer to things turning around, closer to earnings momentum coming in, rather than being passive investors for a very long period of time. So by timing, I mean that we would like to be investors into a company during the up move or during the good phase of this company. This to us is very critical in generating alpha. And the last point is S, which stands for structural opportunities. These are the typical consumer-facing companies. These are the market leaders in various sectors where the earnings are structural. They are getting tailwinds from the demographics, from the macro positives India has, and they have a very secular, steady earnings growth. Obviously, these companies traded a premium for this reason, and we are pretty excited to be invested in them, but at the same time mindful of the valuations that we have to pay. So we would like to strike a good balance between what we are paying and the kind of structural growth that we are getting from these companies. For us, risk-reward equation is very important. The risk we are taking, if the reward compensates for that, then definitely that is something that we will consider with the portfolio. So this is probably the MEETS framework that we follow. It's a very simple framework, but very effective if you religiously follow it. And we are pretty happy that in the past 3 years, we have followed it to the T and would like to continue with this.
Kamal, just to add here, portfolio creation and generating portfolio alpha is a function of two things. Typically what people tend to do is follow only on one thing, but it's a function of two things. So what do most investors focus on? Picking the best stocks. Obviously everyone would like to pick the best stock. But your portfolio return are also a function of avoiding stocks which can eat into the returns. If you have 10 stocks and 5, 6 do well and 4, 5 don't do well, then your returns will be very, very moderate. So I think I would say the trick is also to avoid stocks which can eat into your returns. And by following this framework, not only we are able to shortlist good companies, but we are able to avoid companies which normally, in a bull market like this, you would tend to be a little bit lax or lenient and end up, spoiling the quality of the portfolio. So I think that is very important.
Right, Sunil and Aman. So, my subsequent question that, I put myself in investor's shoe and have a look at your portfolio. Let's stick to Abakkus all cap portfolio. And you have put stress on earnings as well as on quality, right? So my understanding as a, layman is that when it comes to quality and earnings, we will talk about stocks like HDFC Bank, stocks like Infosys, right? Or stocks like Bajaj Finance. Against these, all cap portfolio against HDFC Bank has ICICI Bank. Against Infosys has HCL, right? Against Bajaj Finance, it has LIC Housing Finance or IFL Finance. So, it definitely looks a value portfolio, value-focused portfolio. But when we call it a, portfolio which has earnings, right? So how would you kind of, explain this part?
So it's a good question, and I think that is exactly. I think it will be of a lot of interest if you just extrapolate the names which you took and just go back 5-7 years and actually see the earnings growth of one over the other. I think you will get the answer. So one is things which have already happened in the past, and the other is what we believe is going to happen in the immediate future. See, equity investing is all about the future. Equity investing is not about the past. And all the names which you mentioned, which we don't have, are great companies. But as I said, they are priced to perfection. The best company is not necessarily the best stock. That we have to remember if it is priced to perfection. And I think when we create a portfolio, therefore, even in the large caps and some of the names which you mentioned, which we have in our large caps, actually, if you see, they are not allocations. So the companies which we don't have are allocation companies. You would find them in either the ETFs or in funds who are sort of managing it lazily with the perspective of giving you nifty kind of returns. That is not our perspective. We want to invest. We don't want to allocate. At the same time, none of these companies would be of suspect quality. Because, when we talk about management, we also talk about return on equity. We also talk about track record. Aman mentioned to you the other characteristics, and I think that is where every stock has to go through that MEETS framework for us to have an entry into the portfolio. And I think if you actually see last 4 or 5 years, which is the best performing banking stock, it is ICICI Bank. It is not the name which you mentioned. When you see the NBFC which has performed the best, it is Muthoot Finance, not the NBFC which you mentioned. So I think somewhere, there is a gap between perception and reality. And sometimes perception overtakes our thought process, and that is what we try to avoid by following the process.
2019, when you came up with the report on bubble inequality, those investors who actually, believed in that report and invested are definitely parting today because they have doubled their wealth. In fact, many have more than doubled their wealth, depending upon what time they invested. But at the same time, those investors who remained with quality and who are sticking to quality, they have also had decent returns. But obviously, back of their mind, they might be thinking that, we could have made much higher returns. But still, there is, the valuations of the high quality names that just are rising, right? So there are stocks like, we are trading at 100p and maybe more than 100p. So, and at the same time today, we know that small caps have also rallied and small caps have gone, higher, more in terms of valuation than even large caps. So what are your views with regards to bubble inequality at this moment? And at the same time, do you think that we are near to saying that there is a bubble in small caps?
So great questions and very relevant. So first is on the bubble inequality. So I think completely agree that quality is of paramount importance and it should not be ignored. I think the thought process which we have is, I mentioned earlier, that you can justify a PE based on the growth rate. So if a company is growing at 10-11%, how do you justify a 70-80 PE multiple? And to just expect that the returns will be made from PE going higher and higher, I don't know till when that would last. Because if you actually compare the so-called quality companies in India with companies overseas, whether it is in US, China, Europe, any other geographies, there are no geographies in the world where any company has traded at a PE multiple of more than 50 times for more than 5 years. So I think India is an exception, and I don't know till when it will last. There are a lot of companies which have already started to underperform big time. Obviously, we have a tailwind. If the market goes up 100%, I think even if a company does 40-50%, for the investor, 40-50% is also a great return. But compared to the market, it's underperformed by 50%. So, let the market returns start to normalize, then the difference will be very, very obvious. The other thing is the whole genesis of investing in the so-called 70-80 PE multiple is based on the fact that someone else will come and buy it higher than you. So you're not justifying it fundamentally. You're justifying it by the fact that it's quality, someone else will come and buy from you. And I think that is not what we would like to do. As I mentioned, investing in equity is becoming a partner in the business. And if you are okay to becoming a partner in the business at 80 times or 90 times, then only you should buy equity. Coming to your second question about small caps and mid cap prices, yes, a lot of small caps and mid cap prices have moved up. It's a reflection of 2-3 things. One is they were significantly undervalued. I mentioned to you that 18, 19, and even till the first half of 20, no one was looking at them because of the bad experience they had post 2017 market meltdown. And therefore, their valuations were significantly lower than their long-term trend. Then second thing was that the earnings growth came up much higher than what the market was expecting. As a result of which, there was an earnings growth and there was a PE multiple increase also. And therefore, you have stocks which have gone up 2 times, 4 times, 5 times, even 10 times. At this point of time, you have definitely some portion of the markets which are, I would say, excessively priced. And that is the segment which you have to be very careful about. At the same time, it's not universal. It's not that all the market, whether it is large, mid cap, small caps, are expensive. There is this definitely one pocket where there is over exuberance being built up, and we have to be careful about it. From our portfolio perspective, just to give you a perspective, the portfolio PE multiple for all cap is 16 times. And the portfolio PE multiple for our emerging opportunities, the mid and small cap fund, is only 13.5 times 1 year forward. So despite this 100% plus returns, I think we are in that segment where valuations give us a lot of comfort even now for our portfolio companies. As I said, we would like to make returns out of the profit growth of the underlying portfolio rather than hoping that someone else will come and buy it higher from our side. So, that would be our thing. I would request all the viewers who are logged in that please dissuade from hope trade and stories. Right now, a lot of stories are floating around. Anything to do with chemicals is now touted as specialty chemicals. Anything to do with, anything is now classified as digital. So we have to be a little bit careful about storytelling and focus on fundamentals. And I think if we do that, decent mid-teen returns can still be made.
Right, Sunil, well said. So, what is your view regards to India's economy, corporate earnings, given the fact that, yes, we understand because, COVID happened, and despite that, the earnings till last financial year have surprised positively. But having said that, the unorganized economy, which is also a very large part of India's economy, has definitely been hit, especially in the COVID wave 2. And the first quarter results for financial year 22 are will be starting after maybe a month, right? So given this as a reality, and now we know the valuations have come up, so maybe the possibility of easy money making is no more there. Though there would be possibilities, similar opportunity, some opportunities still might be there, but overall, broadly that opportunity is gone, right? So given this as a juncture where we are standing, what is the kind of a portfolio, or what is the kind of a advice that you would like to give to various investors, and what are your views with regards to India's corporate earnings and economy for financial year 22 and maybe for next 2-3 years?
So a lot of questions in one question. So first of all, I think you have to understand the environment right now. When we come to COVID was a black box. No one who was alive had ever seen anything like COVID. And therefore, when the first wave hit us, we reacted in panic. There was complete lockdown. The economy came to a standstill. There were only 5,000 cases all over India. Still, the economy came to a standstill. The second COVID wave, in fact, was emotionally much more distressing because each one of us had a patient either in the home, in the office, or in the nearby neighborhood. And a lot of fellow Indians and some relatives also lost their life. Some were seriously ill, and it was very, very distressing. I would completely agree with you that a portion of India also faced a lot of issues financially. जिसके घर में COVID हुआ, they had to bear a lot of medical expenses. Businesses, particularly the SME side, the small retail, small shops, hawkers, all had issues, and therefore we really, really sympathize with them. However, let us come over it and let us think a little bit dispassionately. One is vaccine seems to be working, and in whichever country vaccine percentage has gone over 50%, the number of cases have reduced. Even in India, the number of cases from a peak of 4 lakh are down to 60,000-70,000, and hopefully we will have majority of the population vaccinated. If we go by the increased vaccines, anywhere between 30 lakh to 40 lakhs a day is already started, and it is expected that by July and August we would be significantly higher than this number, and by December we would be as a country vaccinated to a large extent. Now, whether this third wave, fourth wave comes, we don't know, but mankind is mankind. The second wave had a less impact on economy than the first wave, despite the higher numbers, and we are expecting that even if the third wave comes in, we know how to react and the impact would be much less. The other thing is liquidity is available in plenty, and it is not going to go in a hurry. Despite yesterday's comments of US Fed of starting to taper off in 2 years, we have seen that markets globally have, after an initial panic, recovered quite beautifully. Even in India, we started with a gap down and we closed almost in the green. And even in the US, it is expected that it has been already discounted. The other thing is all the governments in the world are now planning to spend huge sums of money in infrastructure, almost 12, $13 trillion, including $1 trillion in India, $6 trillion in the US, and so on and so forth. And for a change, because unlike 2020, where the recovery was predominantly into some consumption names in IT and pharma, this time the recovery is in steel, in metals, in cement, in infrastructure, in capital goods. You name it, and there is recovery. And companies don't have capacity. As a result of which, after almost 5-7 years, for the first time, you are seeing animal spirits in Indian entrepreneur waking up, and almost all companies having plans of capacity expansion. And that breeds another second wave of growth in the economy. We also don't have to forget that China is sort of the villain in the world. Increasingly, countries are preferring to import from countries other than China. You cannot wish away China completely, but every country is benefiting, including India. So whether it is textiles, garments, machinery, metals, we are seeing an uptick as far as export is concerned. And because of the import restriction and the PLI scheme, we are also seeing merit in setting up manufacturing in India. Already we are seeing in electronics big facilities being set up. So is the case in chemicals and textiles and so on and so forth. There is some inflation. In fact, inflation to some extent is beneficial because it increases corporate profitability. At the same time, we are in a sweet spot where there is some inflation and interest rates continue to be low. So, you have an uptick in your sales and you have a downtick in your cost because of lower interest costs. So earnings can surprise on the upside. So I think given all this, we do believe that there is merit in investing in equities. And as I said, you can expect decent mid-teen returns. Now, if you start to expect 50-100% return year after year, it is an unrealistic expectation and you will be disappointed. But now look at the alternative. If you invest in fixed income, you make 5-6% in which the government of India is a partner to the extent of 30-40%, depending on your tax rate. You end up making 3-4%. And I think in that comparison, a double-digit return in equity is a significantly good return. And I would sincerely urge investors to have reasonable expectation, and you will not be disappointed.
Right. So my next question again, has two parts to it. Your all-cap portfolio, I was checking, has 20% exposure to NBFCs. And at the same time, you're also holding around similar amount in cash. Why is that so? And, what are your thoughts in that regards?
We don't have any cash. I think that figure is not right. I think we are more or less anywhere between 94-95% investors. So that number is maybe there is some transitionary something. See, as far as NBFCs or banking is concerned, we have divided the segment into two parts. One is the fund-based financials. So fund-based financials are banks and NBFCs which lend money. The other is the non-fund-based NBFCs or financial companies. So we are very bullish on exchanges. We are very bullish on broking houses. We are very bullish on insurance companies. And therefore, we have an insurance company in our portfolio. We have a large, a broking company in our portfolio. We have the only stock exchange listed, which is in our portfolio. And therefore, that weightage looks to be pretty high. But these are financial companies which are not impacted by the so-called NPAs and so on and so forth. In fact, they are positively impacted. The insurance companies are positively impacted because post-COVID, everyone has realized that you need to have much larger amount of insurance than anyone had. And because of the increased, I would say, interest in equity markets from a longer-term perspective, any companies which are exposed or dependent on equity markets will do well.
My understanding of your style of investing is bottom up, wherein which you put most focus on identifying a business because you are entering as a partner and trying to enter into a business where there is a earning visibility and at the same time business available at a right price, and which is what you define as value plus growth. right? But at the same time, your portfolio has very differentiated sectors. So do you also take a sectoral call, or do you also do some kind of sector rotation and think of, how particular sector will participate in economy, and then hence beyond micro, you also do some kind of macro analysis while constructing the portfolio?
Aman, you want to touch upon the sector rotation part? I will touch upon the macro part then.
Sure. Kamal, as far as sectors are concerned, while we clearly are bottoms-up investors, we do have our calls on the sector. By calls, I mean that we thoroughly analyze the sectoral prospects, because if in this particular sector, for a certain reason, if you're not doing well, you could be the best company in that sector, but you will be facing some kind of headwinds. The best situation is that you are a great company into a great sector. So we do have our sector calls in place. That doesn't mean that we have complete, say if I don't like a certain sector, we'll completely ignore that sector. Not necessarily. If there's a bottom-up story which merits investing, we'll definitely look at it. From a sector rotation perspective, yeah, there are times when we were investing into certain sectors. There are times when we are not. For example, today we don't have any exposure to auto sector or auto ag. We feel that the auto companies would be facing margin pressures due to the rising input costs, and the current valuation doesn't justify that, or we see risk to earnings, to consensus earnings in this sector. At the same time, compared to 2 years back, today we are more bullish on the infrastructure, we are more bullish on cement, we are more bullish on domestic manufacturing, because certain government policies have changed, which has made these sectors much more interesting, much more capital is being flowing into this sector, and the growth prospects has definitely improved. So we clearly take a look on these trends, and this does play an important role into the kind of investments that we make.
See, on the macro front, and just taking away from what Aman mentioned, see, if you're a trader, you can keep on shifting sectors every week, every 10 days. Today, sugar ka din hai, kal steel ka din hai, fir paper ka din hai, and it's very easy to just keep on moving from one another, but you don't create wealth, or you don't create portfolios based on that. So I think our sector allocation is well thought out, and I would say that we have a 3-4 years view. So even if we are very positive on steel, we know that it is very cyclical, and therefore we limit our exposure to that sector, despite the fact that all our stock picking would be bottoms up. So you have to, at least, you can't have 60% in steel just because bottoms up every steel company looks good. I'm just giving you a perspective. From a macro perspective, it definitely makes a lot of difference. Sometimes when you are looking at companies, you also have to look at the macro environment. So for example, now, if most of the companies are going go for capex, you have to start analyzing that which companies and which segments would benefit if this actually happens. When interest rates fall, frankly, the real estate sector, particularly on the housing side, was a clear beneficiary. It's another thing that none of the companies which are listed qualified in our meets framework. And we are very, very stringent, even if we believe that there is an upside, but if the companies don't qualify, we avoid taking an exposure. So this macro also has to be taken into consideration. But, it's not like a formula based. When you're creating a portfolio, when you're analyzing companies, all this form a part of the research process which goes into shortlisting these companies.
And Kamal, just to add, in the current portfolios, we will be having anywhere between 14 to 15 different sector exposures. So it's a quite well diversified portfolio that we currently manage.
Right. So when it comes to selecting a product amongst various PMSs, we have a platform, PMS App World, where we give a lot of data and information not only about performance but also about risk measures, which cover Sharpe ratio, which cover beta, and also we put things like information ratio for investors to understand and then take a right and informed call. But beyond this information, investors try and go by their basic understanding and their gut, and they compare popular brands. Like, for example, if one has to deploy a 1 crore as an amount or a 2 crore as an amount, one would say, okay, investing in Marcellus does not matter because their timing is okay because these are good companies. I may want to buy at even these levels because markets have run up. When it comes to investing in ASK, there also, the perception is that preservation of capital and compounding both are done hand in hand. Right now, when it comes to Abakkus, absolutely seeing that there is a 2x return given in last 2 years, and definitely one believes more in bubble in quality kind of notes now after having seen your success. So investors are definitely wanting to invest in Abakkus, but at the same time they are worried that their timing may not be right, and that is why I, as an advisor, when investor asks me this question, I would tend to say that rather than going for, say, emerging opportunities PMS, you could go for all cap PMS, right? So that is how I would, put it. But if this question comes to you, and if this is the conversation you are in with a client, how would you, kind of address this?
So, Kamal, it's a very justifiable thing. One is I have worked in the mutual fund industry for a long time. So I will repeat that past performance is not a reflection for future performance. So if you are looking at Abakkus, don't give us the money just because our past has been excellent. You have to see the future, because equity returns, as I said, is all about the future. The second thing is I will again highlight is that perception is very different from reality. So unlike the perception that there are other stable portfolios with quality, and we would not have that, please go through the underlying companies. You will see that most of our companies, or all of them, have great ROEs. The debt equity ratio of both our funds is like 0.1 times. The ROEs of both our fund at the fund level is 18-19%. The profit growth is upwards of 18-19%. And the PE I mentioned, one fund is some 16 times, the other fund is 13 times. We are half of the PE of Nifty, higher than the Nifty ROEs and higher than the Nifty in terms of growth, and much lower debt equity. So I think all these are aspects which describe the quality of the portfolio. The other thing is, as I mentioned, it is not necessary that just because a company is small, the quality is bad, and just because the company is large, the quality is good. We have seen a lot of mishaps, mostly in the larger companies than in the smaller companies, and therefore, just because a company is large, the mishap will happen. It does not make sense. The other thing is, if you mentioned, if you are an investor who does not like too much volatility, all cap would be the portfolio, which will give you the volatility, which will be comparable to Nifty, but with much higher returns. And mid and small cap, which is the emerging opportunities, obviously will give you much higher return, but with slightly higher volatility, which is obviously going to happen because of what the segment is in. The other thing is, if you're an investor who are investing for the future, you also have to invest in upcoming sectors. And upcoming sectors will necessarily be in the mid and the small cap side. So, if you're wanting to invest in a digital company, or if you're wanting to invest in a homegrown branded company, if you're wanting to invest in a niche financial services company, you can't find them in the Nifty. You will find them in the Nifty after 5 years. So obviously we are trying to look at companies which can hopefully become larger over the next 5-7 years, rather than which have already become large. And the other thing is, in the emerging opportunities, the mid and small cap portfolio, we have this unique concept of 15-15-15, which ensures that we don't get carried away in the mishap. But for an investor who obviously is looking at a higher return, but much more stability, all cap is a great portfolio. We have around 40-45% invested in large caps, and the balance in larger mid caps, which will have a market cap of roughly $500 million to $5 billion. And despite that, I think the returns have been pretty decent, So in a 1 year period, if emerging opportunities would have given you 130% return, all cap would have given you 110% return, which is much higher than the Nifty, which would have given you 60-70% return.
Are there any immediate risks, after especially the Fed's announcement in terms of guidance, or, as inflation is gradually rising, which you see, which could take equity markets down by more than 10% levels over next, say, 2 quarters or 3 quarters?
So, again, on a lighter note, equity markets are like a cardiogram. As long as your cardiogram is up and down, your doctor will not be worried. It should not be a straight line. I think markets are also like that. They are like cardiogram. They will always have ups and downs. However, given the fact that people are very cautious. We are not in a scenario where people are gung-ho and they are borrowing money and the leverage position is very high. Yes, there is definitely participation, but people are very cautious. And in such kind of a cautious scenario, reactions are going to be short and swift. So we have had reactions last 2-3 days. Nifty has reacted by 2-3%. Mid and small cap might have reacted by 3-4%. Individual stocks have reacted 10, 15, 20%. So you are going to have these bouts of short and swift corrections. At least on the basis of things which we know, we don't see very deep corrections. But deep corrections happen in the market when we are hit by something which we don't know or which we don't foresee. No one foresaw Lehman Brothers, no one foresaw COVID. So unless that kind of an event comes, we don't see a major correction. But short and swift corrections, one should always be prepared for.
So given the valuation gap between large cap, mid cap and small caps, where small caps are highest, mid caps are maybe in middle, and maybe large caps are maybe relatively lower or maybe similar, how would you advise an investor in this regards?
Kamal, I think we spend a lot of time on this large cap, mid cap, small cap. Ultimately, it is all about investing. If your horizon is 3-4 years, I think you should not even bother about large cap, mid cap, small cap. Because we think that small cap and mid caps are risk. They are volatile. Volatility is higher there because obviously the business model of these companies are not as evolved as the large caps. From an investor perspective, the investor has to balance the portfolio. You should not have 100% in small cap, but you can't even live without having an exposure to them, because then your alpha creation will reduce quite significantly. I think from our side, as I mentioned to you, as movies are all about entertainment, market returns are all about earnings. You might have the largest cap, but if there is no earning growth, there is not going to be any return. There are so many memes which float around the largest cigarette company. There's been zero return over the last 6-7 years. It's a large cap, it's quality and everything, consistent, compounder, all those qualities are there, but it has not given any return because earnings growth are not there. So ultimately, create a portfolio where there can be sustainable earnings growth. And as I said, an all cap is a great strategy because it has a mix of both. So, rather than having two separate funds, you can have one fund where you have the benefit of stability because of the large cap exposure. And you also have the alpha creation possibility because of the mid cap exposure.
How does Abakkus take a decision in terms of allocating between equities and maybe holding cash? Is there any flexibility or any policy in place in terms of link to valuations or market view?
So I would say almost or most of the time we will not take a cash call beyond 3, 4, 5%. That is also operational. We always like to have 3, 4, 5% cash because someday you might have an opportunity and you don't want to miss out on that. However, our view is that when the investor is allocating money to us, we are obliged to invest that money. We have still not encountered a situation since we started where we believe that we are in that frothy kind of a thing and we have to create cash. I think if that situation comes, we will stop accepting inflows rather than, accept the inflow and then sit on cash, because you don't want to be charging your investors on the cash which you want. So that situation we still have not seen. But, if we get into a situation where, the market becomes very frothy, we will give the signal to the investors by saying that we suspend taking fresh subscriptions.
So your portfolios have allocation to cyclical businesses. And, when I show your portfolio to say any client, the client would say, investor would say that because Abakkus style of investing is value and in cyclicals there is a value, that is why they have no option but to add cyclicals, because they have to stick to their style of investing, which is, value. But obviously I understand that you're not only chasing value, you're chasing value and growth. And this is what you have explained, earnings. But I would want you to spend maybe 5 minutes, and this is the last question, on explaining your view on cyclicals and why and how you see cyclicals as being backed by earnings, and how big is this story, and why you have large allocation to cyclicals.
So first of all, I think this whole question is not exactly correct. If you see our cyclical exposure, it is very minuscule. In fact, the largest weight to any sector in our portfolio is to tech/IT/digital, which I'm definitely sure that none of us would call it cyclical. But we have been very conscious of the value at which we bought this growth sector. In fact, the whole cyclical sector put together would be maybe 10%. As I said, even though we are positive on steel is not even 5% of our portfolio. Sugar, chemicals, I would talk about the base level chemical will be not more than 5%. So we are not cyclical. I think this whole concept that if you are a little bit value focused, you become cyclical is all wrong. We invested in innerwear companies which were catering to tier 2, tier 3 and villages. We got them at 15, 17 P. Why should we buy a 90 P innerwear company which is growing at 10% and ignore a 20% growth company with the same ROEs and debt-free and net cash company available at 15 P? So I think, this whole concept that because you are value focused, you are only in cyclical is all wrong. If you see the portfolio, barring 3-4 companies, you will not find any cyclical. They are all growth companies. We have, building material focused companies, which we bought at 7P. And, they've become 4X. And even now they are 14, 15P because the earnings growth was also very high. So why should we buy a paint company at 90P, which is growing at 10%, and ignore a building material company which is growing at 30% available at 10P with similar ROEs? So I think, this I don't agree with your statement that we are in cyclicals. I think if you see the portfolio, you would realize what we are trying to say. Right. So we are very clear, unless there is growth, which Aman mentioned to you when we were explaining needs framework, there is no return. We are growth focused, but we would buy something where we believe that the value we are paying is lower than what we will get by way of future cash flows.
Right. So this, Paul, has been really very helpful to, I would say, address a lot of misconceptions and align expectations of investors. And though I, said that that's the last question, but if you allow me, I'll just ask, one more question I have just identified from the chat. An investor or anyone, who has written this is trying to ask this, that your philosophy is 15, 15, 15, wherein which we understand that we are trying to identify, those businesses which have sales growth more than 15% and which have P less than 15, and at the same time, earnings of more than 15%. So identifying these companies maybe, 1 year ago or maybe today is possible. But do you think it will remain possible, on ongoing basis, or, because, beyond a point, what will happen for you to stick to your principle, you will have to pick some of those names, which will actually be those which have been ignored by market for some reason, for some problem in them. But you will kind of, have to add to them because, they have fulfilled your 15 principle. So this is again a misconception, which, again, very large investors would kind of pose who meet other fund managers also. So I want you to address this last point also, and then.
No, I think it's a relevant question. General, the perception is that we would end up buying companies which have some problem, and that's why they are cheap. That is possible in some of the companies. But I think the real reason is that to actually create a differentiated portfolio, one has to work very hard. One has to have a large team. We have a 14-member team on the investment side, despite having such small operations. We have 125 years of experience of tracking Indian companies cumulatively. I personally read more than 1,200, 1,500 balance sheets. I am very sure all my team members also do the same. It takes a lot of effort to get into companies where there is no external help. It is very easy to get into companies where there are 50 other analysts who are tracking it and who can give you ready-made reports. So I think a lot of these companies you are able to identify because you don't ignore them. See, India is a country of entrepreneurs. India grows because of entrepreneurs and despite the government. And the good thing is we have so many listed companies. We actually start with 1,500 companies. We have a 5D process. So the discovery part starts from 1,500 companies, and by the time we deliver, we have shortlisted it to 65, 70 companies. Some tech companies, some digital companies, we were able to identify because we are also tracking the trends in the global markets. We read a lot. We have this, what we are reading, what we are seeing, which you must be getting, which is curated out of all the reading that we do. And we were able to analyze the trend. We were able to understand this concept of platform companies, the CPaaS companies, the PaaS companies, and therefore we were able to buy a company which has given us 5x return at 15p multiple. We were able to buy a travel company and so on and so forth because we track those companies. The risks which we take are also very well thought out. So when you are doing a portfolio analysis, you will end up having some stocks which you believe are slightly higher risk, but which can give you disproportionate return. And you can say, okay, 2% of my portfolio, I'm okay to investing in this. I might lose 0.5%, but I might make 5%. So I think all this also comes with experience. Between me and Aman, together we have almost 40 years of experience of managing funds. It's not about only tracking Indian companies, but managing funds and managing almost 8,000 crores of funds. So I think all this also comes in handy. So to say that we are only investing in companies because there's a problem, I think is not there. Some companies, yes, you might take opportunity, which is where Aman mentioned events, trends, and disruptions. Some trends will give you an opportunity to buy something at a price which you would have dreamed about buying. I think Corona was one event which gave you an opportunity. Sometimes it might be a company-specific event. UPL had an issue which was blown out of proportion because of something which was personally some issue, and the stock is doubled from there. So I think you have to be alert, and I think that is where some extra effort helps in creating a portfolio which can create long-term wealth.
Right. And the last point that I would want you to address is about diversification. Unlike many other portfolio management services, I see your portfolio as having more than 25 names, around maybe 30 names, and I can see somebody written in the chat also that what are your views in this regards, and why your portfolio has so many stocks?
So see, we are dealing with a segment which is very stock specific. And I think there are 2-3 aspects to it. One is you want to diversify risk. So it is very easy to say that you can buy 10% and buy 10 companies. But, markets are fragile, segments are fragile. There is this whole disruption which is going on. Models can completely get skewed because of some disruption coming in. And I think in this kind of a scenario, our view is that, restrict exposure to one company to 5% at the time of investing. After that, because of appreciation, if it goes up, we are fine with it. The other thing is that sometimes you have a conviction on the company, but it might not be a conviction which can make you buy it 10%. You might end up saying that, okay, this company is a high return candidate, but there is slightly higher risk. So let us restrict our exposure to this company to 2-3%. And which is what we have done. So our largest exposure in our AIF Route Mobile, we started with 2% exposure. It's become 8% out of appreciation. So which is fine because it was a new sort of a segment. And I think we believe that this 25, 30 odd names gives it a proper diversification across sectors, also reduces the risk which one or two companies doing well or doing badly might present to the investor.
Thank you, Sunil, and thank you, Aman, for spending so much time. We have almost covered 1 hour, and I would just sum it up by saying that because now over next 1 decade we would see a period of India's economic growth coming back. Hence, there is definite likelihood, and that is exactly what is being seen. There are many quality names which are expensive, which will start to stare And at the same time, there are companies which are good companies, which are having earnings, backing them and are available at right prices. They will be seen with a different perspective, and hence we'll see, price re-rating. And that is the kind of, shift which we have already seen over last, 1 year. And this is the beginning of that shift. And for those investors who do not want to, invest with too much risk, for them, all cap portfolio of Abakkus, which provides a very fine blend of large cap, mid cap, and small cap, and is also very careful of value in terms of identifying companies, is a very fine portfolio to consider. Thank you everyone for logging today, and thank you Sunil and Aman once again. Thank you.
Thank you for having us. Thank you.
Sure. Thanks everyone.
Have a great weekend. Bye.
Bye.